Do you feel overwhelmed by the avalanche of taxes lately? Many businessmen do, and they're struggling to cope. It's quite inevitable because the Malaysian government needs to raise taxes to cover the budget shortfall brought about by many factors, one of which was the overspending during the COVID-19 period. Probably, the chickens have come home to roost and we have to live with higher taxes. What are these taxes? Number 1, tax on foreign source income, or FSI. What is the nature of this tax? Many Malaysian taxpayers earn income from abroad. These include dividends, interest, rent, royalties, fees, etc. received from overseas. If they remit this income back to Malaysia, they will be taxed as FSI. FSI is therefore a tax on foreign source income. If they do not remit the income back to Malaysia, the income is not taxable. In the past, foreign source income remitted back to Malaysia was not taxable. However, with effect from 1st January 2022, all of this income is taxable unless the income or the recipients are exempted from tax. The tax rate is the same as the normal tax rate of the taxpayer. If you are a company, the FSI will be added on to your income and taxed at 24%. Who are the taxable persons? The tax was originally targeted at all Malaysian tax residents. However, exemption is now available for resident individuals until 31 December 2036. Hence, only non-individuals, example companies, limited liability partnerships, trusts, etc. are taxable. Within these non-individuals, companies and LLPs are exempted from tax on their foreign dividend income received until 31st December 2026. Other types of income of these companies and LLPs are still taxable under FSI. The second tax is CGT, or capital gains tax. What is the nature of this tax? Capital gains tax, or CGT, is a tax on capital gains. In contrast, income tax is a tax on income. CGT was introduced on 1st of January 2024, but made effective only on 1st of March 2024. The scope of CGT is very narrow. It only applies to a person who makes gains on disposals of unlisted Malaysian company shares. If they make capital gains from disposals of other assets, example, listed company shares, their gains are not taxable. The taxable persons are also limited to 4 groups of taxpayers, and they are companies, limited liability partnerships or LLPs, trust bodies or trusts, and cooperative societies. If you are not one of these 4 types of taxpayers, you do not have to pay CGT. However, if you make capital gains from disposing property or disposing shares in real property companies, you will be liable to real property gains tax, which is another tax altogether. Therefore, CGT depends on the asset disposed and the type of taxpayer. Compared to normal income tax, the rate of tax for CGT is quite low. If you acquired your asset before 31st December 2023 and sold the asset after that date, you are given the option to choose one of 2 rates. That is either 2% of the gross sale proceeds or 10% of the capital gains. However, if you acquired your asset after 31st December 2023 and sold it after that date, you don't have any option. The tax is 10% of the capital gains. The third tax is dividend tax at 2%. What is the nature of this tax? This is a rich man's tax and is effective from 1st of January 2025. This tax is imposed only on resident and non-resident individuals who receive dividend income exceeding 100,000 ringgit in a year. They will be taxable on the dividend exceeding 100,000 at the rate of 2%. Other taxpayers such as companies which receive similar dividend income are exempted from this tax. The type of dividends liable to this tax are very specific. They must be dividends received from Malaysian tax resident companies. If the individuals receive dividends from overseas companies, the dividends are not subject to this dividend tax. Taxpayers can also enjoy exemption if they receive dividends that are specifically exempted, such as dividends from companies with pioneer status, Labuan entities, etc. The fourth tax is EPF on foreign employees at 2%. This EPF is strictly not a tax, but a statutory contribution. In the past, EPF contributions for foreign workers, including expatriates, were voluntary. If the employer opted to contribute, the employee's share was typically 11%, and the employer's share was a fixed 5 ringgit per month. With effect from 1 October 2025, all employers are required to contribute a mandatory 2% EPF contribution on the monthly wages of their foreign workers. These workers include expatriates with valid passports and employment passes issued by the Immigration Department of Malaysia, but exclude domestic workers. Besides being an additional cost to the employer, this EPF will require the employer to register the employees and make the relevant EPF payments monthly. The fifth tax is SST. SST refers to Sales and Service Tax. Sales tax is a tax imposed on goods manufactured in Malaysia and on goods imported into Malaysia. Service tax, on the other hand, is a tax on certain services such as professional services. To expand the sales tax and service tax base, sales tax rates will be increased on many products from 0% to 5% or to 10% with effect from 1st of July 2025. At the same time, SST at the rate of 6% or 8% will be imposed on 6 new industries, namely leasing and rental of goods and premises, financial services, construction services, education, healthcare, and logistics. Therefore, landlords, financial institutions, contractors, educational institutions, hospitals, and logistics providers will have to collect service tax with effect from 1st of July 2025. Number 6 is a self-assessment system for real property gains tax, or RPGT. RPGT has always been imposed on disposal of real property or shares in real property companies. The rates of tax depend on the period of ownership and ranges from 0% to 30%. In the past, taxpayers had to submit their RPGT tax returns and wait for the IRB to compute the RPGT payable. In an effort to minimize administration effort on the part of the IRB, taxpayers are required to self-assess, report, and pay the tax payable to the IRB independently. The IRB will not assess the RPGT payable for the taxpayer in future. The effective date of this self-assessment system is 1st January 2025. Number 7 is a self-assessment system for stamp duty. Stamp duty is imposed on instruments or documents which are liable to stamp duty. Examples are sale and purchase agreements, transfer forms for shares, memorandum of transfer for properties, etc. In the past, taxpayers had to submit the relevant documents to the IRB for the IRB to assess the stamp duty payable. The IRB now requires all taxpayers who have executed instruments liable to stamp duty to self-assess the stamp duty and pay the duty payable to the IRB independently. The IRB will not assess the stamp duty payable for the taxpayer in future. This self-assessment system will be rolled out in phases on 1st January 2026, 1st January 2027, and 1st January 2028, depending on the instrument or document to be stamped. Prior to implementation of the self-assessment system for stamp duty on 1st January 2026, the IRB announced on 6 June 2025 that employment contracts are subject to a nominal duty of 10 ringgit per contract. This caught many taxpayers by surprise because they were not aware that such employment contracts are liable to stamp duty. Nevertheless, employers are given a concession in that they are not required to stamp these employment contracts in 2023 and 2024, but they have to stamp all contracts from 2025 onwards. Penalties on the 2025 contracts will be waived if the stamp duty is paid before the end of 2025. If you feel overwhelmed by the avalanche of taxes and require information or assistance, please contact us or check out our previous articles on these taxes.